This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Dianne Crocker. For the week of January 13th to the 17th, 10-year Treasury yields eased off earlier highs as investors digested fresh inflation data that compared favorably to forecasts. Big banks kicked off earnings season with some bullish results in deal-making, and retail sales for December showed solid performance. Manus, the market's got a boost from this latest round of data after reacting to last Friday's employment data.
Yeah, I think we all caught a big wave or sigh of relief coming from property owners, investors, people that are looking to refinance loans, bankers. There had been a lot of enthusiasm at the end of the year and early this year that the CRE markets, market activity, market velocity was going to really pick up this year. It was great to see. But over the last week or two, I felt like every conversation ended with a little nervous laughter, which was, as long as the 10-year Treasury doesn't get to 5%. People were starting to get a little nervous about that. We got up to 480. That CPI number seemed to turn the tide. It wasn't a great number. We were still trending upward. At the headline level, we were pretty much right on line with expectations, but people really latched onto the core. The core came in lower than expected. That is one measure that the Fed really looks at. And what that did was drive a 15 basis point dip in the 10-year rate, and it drove a real big rally in U.S. stocks on, I guess, Wednesday when that number came out. And good for the market. People were looking for a little relief. There was a little bit of nervousness at how much the 10-year had shot up over the last 3 months. And hopefully that helps people eliminate that nervous laughter that we come back to, okay, back to square one. Let's get back to our knitting. Let's start lending. Let's start buying. Let's start deploying capital. And I'm just so happy that we got that level of relief this week.
Yeah, me too, Manus. It's almost like you could feel the market exhale a bit. And, that bullishness that we talked about in last week's podcast, folks really want to hold on to that. And had the report gone in a different direction and had Treasury started to spike again, there would have been a different mindset. So I think it's just a matter of extreme relief on the part of the market after the volatility that we saw at the end of last year.
Let's not forget that it came on the heels of what I would call peak nervousness. We got that very hot jobs number last Friday, more than 100,000 above expectations. It pushed Treasury yields sharply higher. Volatility spiked. Stocks sold off. I think that was peak nervousness for this market. Everybody was saying, wow, we may not see a Fed cut. There was a couple of gasps. Is the next move going to have to be a Fed hike? That CPI number was welcome. The reaction was affirmative. We're back to where we were a couple of weeks ago, thank goodness. And as I said, the market needed this. We needed that positive print, and it goes hand in hand with some other prints that I know Martha's going to talk about shortly.
Yes, it leads me very easily into retail sales, which was a slight miss, but still pretty good.
I think we like pretty good right now. I mean, as a U.S. economy, we like a high GDP number. We like high retail sales. We like hot job numbers because it means that people are going to work. It means people are buying things. It means that the economy is functioning on all cylinders. But we all know from our experience that hot can be too hot. Buster Poindexter at the wedding, hot, hot, hot. Great when you're on the rumble line, not great when you're talking about economic prints. And so when you see a middling print like retail sales, you don't feel terrible. You think, okay, that's kind of a Goldilocks number. It's not going to force the Fed's hand. It's not going to make interest rates go up. It's a nice middling number that we could say the U.S. economy is good, but not great, which as borrowers, as lenders, as brokers, as originators, that's where we want to live.
Yeah, not great, though, if you're a restaurant owner. Apparently, restaurant sales dropped for the first time in 9 months. So I don't know if people were avoiding eating out because they were shopping for gifts instead, but it's kind of what we saw.
Well, it could go hand in hand with the late Thanksgiving that People had seen their friends, they had seen their family, they had socialized a lot at the end of November, and that spilled over to say, let's take a week off. Let's not overstuff ourselves again. But it also could go hand in hand with one of the really nagging things about this economy has been the price of food, right? It has been probably the worst part of inflation of anything, right? We're not seeing inflation any longer among like utilities, right? That has been bumping along at a really low level right now. People are not paying those high prices they were paying 2 years ago, but they are still paying it for food. And that may be what's weighing on the market as well. So it could be one or the other, but certainly I root for our waiters and waitresses. I wanted them to get their pockets full of nice tips, or especially around the holidays. I know that, restaurant owners or small business owners, I root for them all the time. So I wish it had been a better December.
I think the retail numbers were also refreshing to see, because if you think back to leading up to Thanksgiving and the week after, there were real concerns about how retail would shake out in the holiday season. But the Fed's Beige Book survey this week pointed to strong holiday sales that exceeded expectations. And like you said, they were up, but not increasingly so. And I think given the fact that the retail season was so short, it was reassuring to see that the numbers still held up year on year.
Yeah, I think that I started by talking about the optimism that we had in late 2024, that we had gone into the new year with a lot of optimism. And I do think that I want to stick on that optimism point because we've heard it from a lot of places right now. We talked about late last year how bankers and brokers were saying first quarter was looking really robust. I heard down at CREFC, there was a big conference this month that attracts a lot of people from the CMBS market, a lot of lenders, a lot of money managers. I heard that people thought Q1 was going to be very, very good for them, that lending was continuing apace. So it was a lot of optimism there. And I just got off a call with Baker Hill. They do an annual review of the prior year and the level of optimism that people are seeing. And they put a slide on their presentation, which ran about an hour. And the level of enthusiasm among bankers about profitability, about maintaining expenses, about margin expansion, about growing their loan book was bordering on euphoric. They were saying they hadn't seen this kind of euphoria or even optimism in many, many years. So I'm not sure. Maybe it's just that it's been such a long slog for lenders. It's been a long slog for CRE types that maybe they're just ready for the slog to be over. But we are seeing optimism that is really unprecedented in recent years.
We're going to talk about bank earnings, speaking of lenders, shortly, but I do want to go back to retail sales because we saw news items this week on Macy's and Kohl's that were on the negative side.
Yes, we did see store closings. Macy's with about 65 announced store closings. It seems to be split between furniture outlets, which are kind of smaller and not as profitable, and department stores. A lot of those department stores seem to be in B and C class malls, so not a real surprise there. Kohl's with 25 to 30 store closings as well. I always say that January is store closing month. If a retailer is going to shut the door on non-performing or underperforming stores, they wait for one last holiday season and then they cut the cord. That was the case here. The good news is that over the last 3 years, big retailers have not been big cutters of stores. Retailers seem to have right-sized their footprints between the retail apocalypse of 2017 to 2021, and we haven't seen these kind of headlines in a couple of years. Hopefully, not the beginning of a trend.
Yeah, hopefully. And we just at Lightbox published a blog on 7 retail trends that we think are going to shape 2025. So there's a lot there in terms of new investor partnerships that have retail in their crosshairs. Some investors that never invested in retail before are now coming into the picture. strong consumer spending, ways that big retailers are leveraging technology to enhance the customer experience and stand out. So there's some interesting things happening post-COVID in the retail space. And to your point, Manus, 2024 was the first time in 3 years that the number of store closures outpaced store openings. So you might be right that maybe they're at the point where they've downsized to the extent that they need to. And maybe the Macy's furniture stores and Kohl's are tomorrow's Trader Joe's and Target and Orange Theory Fitness.
There's a couple of parallels right now between 5 or 6 years ago and today, and hopefully I can make sense of this. For a long time, I would say between about 2015 or so and 2021, the term retail apocalypse was bandied about over and over and over again. And if you talk to the man on the street or the woman on the street during that time frame, they would probably tell you that retail was dead, that it was a disaster, that it was really awful. And the reality of it was there was two parts of that story. There was B and C class malls, which were a disaster, where 80% of the value was erased. $200 million malls were selling for 20 million. That was apocalyptic. But there was a whole another side of the market, which was strip malls, grocery anchored properties, shopping centers that were not malls. Those performed really, really well, and their value held up. Now we're in a situation 5 years later where offices are a disaster. It's leading the man on the street or the woman on the street to think CRE is a disaster, but it really is just office. And everything else is kind of soldiering along, more or less. And so some parallels between these two big apocalyptic events that we've seen in the last 5 years really are a little bit more subtle than the national press would have you believe.
If you look back at retail during COVID, I mean, what would we have done without e-commerce? But then I think post-COVID, people were just so eager to get out and experience shopping in a new way. And kudos to the major retailers that met consumers where they were. I mean, you look at like what it's like to go to Walmart now versus pre-COVID. Sometimes you don't even have to get out of your car. They'll bring your goods to you. And I think for retail, they've really embraced newness and figured out how to marry the e-commerce experience with in-store. And that's partly what really kind of killed that prediction about the apocalypse. And now you have investors thinking about getting into retail where they never did before. So there's certainly a lot of excitement, and I think it'll be a good year for retail.
There's some things you just can't get through e-commerce. You're never getting a haircut through e-commerce, right? Let's face it, or at least let's hope so. And I learned the hard way that I'll never again get an at-home haircut. I tried that during COVID when things got really ratty. I let my daughter take a crack at it. It just got to be too much, and that will never happen again. That did not end well.
And Manus, you were talking earlier about the optimism fueling the lending segment. We saw bank earnings this week that were very bullish on deal making.
It's been so far. We've seen a couple of big banks post earnings, B of A and JP Morgan among them, and the numbers have been good. And why shouldn't they be? A couple of things have happened over the last 6 months. One is the yield curve has de-inverted. When the yield curve is inverted, banks are paying a lot for their deposits. They're not making as much on their long-term loans. Now that we've de-inverted, the spread is now positive again. Banks should be making money. Yes, Martha, to your point, there was deal making. People started to tap the capital markets again to make acquisitions. We've seen that pick up. The velocity of money has picked up. And I can't underscore this enough that with every quarter that goes by and we get further and further away from what was the deposit run terror that took place after the failure of Silicon Valley Bank and Signature Bank, that every quarter we get past that, banks get more confident. They deploy capital more. They get less worried about mark-to-market losses, CRE losses, and so forth. And that has led to more confidence. I think that has helped push this level of optimism, if not euphoria, to an even higher level. What do you think, Dianne?
I think that's probably true. And I think it certainly varies bank to bank. If you look at the earnings that just came out, the ones that have the largest exposure to commercial real estate obviously were a little bit more pessimistic than others. I'll throw out Wells Fargo as an example. They definitely pointed to commercial real estate office fundamentals that were still weak, that they still expect office losses to be lumpy, was the adjective that they used, as they continue to actively work with their clients. So I think it varies certainly from bank to bank, but there's optimism building, and I think a sense from lenders in general that they're eager to step back in, which is the sentiment at Crefsey that you referenced earlier.
Well, I think that there's two trends that you're seeing. It's very early in this earnings season, but the two trends I'm noticing is that a year ago, every CEO from a bank that was brought on Squawk Box in the morning or the late afternoon was forced to address how much CRE they had, not just how much office they had, how much CRE and how big a problem this was going to be. Now, what we're seeing a year later is most CEOs are not talking about their CRE book at all. And those that do talk only about problems in office. They're not talking about problems in other segments. So it underscores my point that there's office and there's everything else. Right? And another reason for optimism in the new year.
And we have not yet seen regional banks report earnings yet. That usually comes shortly after the big banks. But there was a report that was published by Florida Atlantic University that looked at bank exposure to risk from commercial real estate.
Yeah, that was really interesting. 59 of the largest 155 U.S. banks have commercial real estate loan exposures that are exceeding 300% of their equity. So that's, obviously going to leave them vulnerable to the eyes of the regulators and making sure that they're doing everything they can to protect themselves. So Manus, number one was Dime Community Bank with 602%. Do you know Dime Community Bank?
I certainly do. They are, I think, headquartered in Queens. I think I had my newspaper route money in that bank when I was a child. You'd walk around and get tips from delivering your newspapers. You get your $8 a week or something like that. You get your passbook savings book out, drop it off at the Dime, and watch that number go up another $8 each week. The good news about them being at the top is nobody would call the Dime systematically or systemically important. But you do bring up a good point that 300% of tier one equity is an important number. Once you get north of that number, the Fed regulators put you up to greater scrutiny. But I don't think that scrutiny is a bad idea. I think it's a very good idea that regulators are looking at this. But I do think it's not going to be a problem. I think for most banks, they have this under control. Those with higher office exposures will probably have more bumpiness. But there was a time a year ago where people were saying we're going to see 30 or 40 or 50 banks fail. That never gets brought up anymore. That doesn't seem to be even hinted at these days, and that's to the good.
The optimism that you spoke about a few minutes ago, and the eagerness of banks looking to reignite originations again, a lot of them, especially the big ones, have been quietly in the early part of 2024 cleaning up their balance sheets, working through loans. To reference back to Wells Fargo and their latest quarterly earnings, their non-performing assets declined 5% from the third quarter. So I do think there's a sense from lenders that the worst is behind them, and they're ready to kind of move away from dealing with what's on their books to cautiously opening up the doors of originations again. And hopefully that's the case this year.
And we've seen banks get pretty good execution. We saw Bank of America sell a big portfolio of loans. The markets are open. There are takers for these loans, maybe not quite at the prices that they'd want to get. Maybe some are below par, but banks are able to reduce their exposure when they need to. And that's a sign of a functioning banking economy.
The other story that we've been watching this week is a sad story, and it's the LA wildfires. You're seeing estimates of damage, the scale of damage, how insurance is potentially impacting the area, and what net migration impact will be. Manus, it's really a sad story.
Well, first of all, it's a tragedy, of course, right? A lot of human life lost. People have lost their homes. We're getting reports of a lot of people who have been in these homes for decades, paid off their mortgage. As a result, they weren't maintaining their insurance because usually insurance is tied to having a mortgage in place. Accordingly, they may not have fire insurance. So it's a tremendously sad story. It's one of many, sadly, that we've seen this year. We saw the damage from Helene run through South Carolina and North Carolina, hitting Asheville very hard. We saw Hurricane Milton, and now we've seen the forest fires. Tremendous human damage, tremendous loss of life and property. That's the headline, of course. The economic impact, you have to look at a couple of different things, and we're not sure how this is going to play out. Certainly, Southern California will have to be rebuilt. Asheville will have to be rebuilt. Parts of Florida. That could have an impact on material costs, driving costs up higher at a time where we're hoping to see some inflationary relief, no doubt about that. We can expect to see a surge in insurance costs that would make it a double whammy for people that are property owners, builders, developers, and so forth. And we hope that that's not the case, but we can't rule it out. And if it comes to pass, we hope that people are generous, either with the Red Cross or with other opportunities to help those in need, or that FEMA comes up with a plan to help people rebuild efficiently and inexpensively. But we won't know the impact of this for many, many months.
Agreed. It's just hard to wrap your head around just the scope of the damage and the logistics of what needs to happen over the coming months and even years. We did touch base with our in-house data expert at Lightbox, Zach Wade, as he's done with previous major events like Katrina, Hurricane Sandy, you mentioned Helene more recently, is he's starting to look at the affected region out there. And we do plan to have him on the podcast, but it's going to take some time before we know the full impact of the LA fires and when he completes his analysis. So we'll definitely have Zach on to talk more about the affected properties.
I certainly think that this puts pressure on the incoming administration, the Trump administration, to be very, very focused on tariffs and what precisely they do in the next 3 months. What you don't want to hit is developers, property owners, and so forth with a triple whammy, right? If you have supply inflation because everybody's trying to rebuild at once, if you have insurance inflation, do you really want to whack people with a third level, which would be supply inflation that's tariff driven? I think that this may lead to a little bit more sober talk, sober rollout of the tariffs that are intended. Let's hope so, because we don't want to see developers and homeowners triple whammied.
All right, let's shift to transactions. Manus, I know you have a few transactions that cover office and multifamily.
Yes, we'll start with the office. One thing that seems to be picking up steam right now, especially in certain markets, is this buy to convert trend. We saw a big headline. This comes from Commercial Observer. The story is David Werner has put up $100 million to buy 675 3rd Avenue. This is kind of Midtown East. The writer there, Isabella Durso, he's going to convert that property from office to residential. I believe this is the second or third spin at this for Werner. I think he's also the one converting the Pfizer building on 42nd Street in Manhattan to residential as well. So this is a process which is getting legs. We're now seeing this in Lower Manhattan, in Midtown, in the Grand Central Terminal area, in Midtown East. There's another one, 1101 First Avenue, that's also being acquired for conversion purposes. So unlike shopping malls from 5 years ago, where people thought that these would be converted to community colleges or industrial centers, maybe logistics properties, that dog never really hunted. Here we're seeing a dog that is hunting, and that is developers coming in, often paying 9-digit prices for properties with the idea of spending another 9 digits to convert them to residential, with the idea of adding to the, in this case, New York City housing stock. So I love these stories. I love the optimism that a developer brings when they buy these things. It's a vote of confidence for the city itself. It solves a problem, which is a housing shortage. And we should all be rooting for guys like David Werner. Let's hope that this goes smoothly and he makes a nice return, and that encourages other people to follow suit.
Here, here. That's a good one.
The other area we're looking at some interesting transactions are in the multifamily space. And I know you've got something going on in Evanston that's worth talking about.
Yeah, Chicago has had a lot of negative headlines. We've seen probably the deepest of deep discounts taking place in that office market, which is saying something. In most markets, things are selling for deep discounts. Chicago seems to be getting the worst of it. We've seen some disappointing apartment sales there. We've seen some suburban distress taking place. So it's always nice when markets that have taken some hits have some positive one. In this case, Hines paid 150 million for Evanston Apartments. Evanston is that suburban area that houses Northwestern University. This is a suburban record. It's the highest price they've seen in many, many years. The seller here was Northwestern Mutual. This is 420,000 per apartment. The reporting there comes from the Real Deal's Sam Lounsbury. So happy to report that. I'll roll into another market that is absolutely on fire right now. It's really hard to believe how many 9 and high 8-digit sales we've seen in this market, but I think it's now 15 or 20 over the last 45 days. Think about this. In the Denver and Denver suburb area, there have been something like 18 apartment sales of $80 million or more since the end of October. That's extraordinary. We saw 6 or 7 of them in December and now another 3 in early January. I'll run them off very quickly. The Cherrywood Village apartment in Parker, Colorado, $103 million. The buyer there, Bell Partners, that represents $285,000 per unit across 360 units. In Denver in particular, the District by Windsor Apartments, that sold for $91 million, $330 per unit. And in Westminster, Colorado, the Retreat at Westminster, that sold for $87 million, $330,000 per unit. Again, the buyers of those last two, Mesero and Berkshire Residential Investments, respectively. So, I think that this is a sign that things are taking off. Apartments have been very sturdy in their sales, very consistent from July until December. But now we're starting to see some markets take off. Colorado just being a real outlier in the amount of economic velocity taking place there. Any idea why this might be so unique? Why Colorado, Dianne and Martha? You have any theories behind this?
Desirable metro to be, a place where young folks want to live. Who knows? It's ski season. Who knows? But I think as you were speaking, Manus, it reminded me that I think the number to beat from December was 41 property transactions on your list that were 9 figures or more. So certainly some of these 15 will go toward the January number, and we'll have to see if that beats December's 41.
Yeah, I have to say, and this may just be me, it does feel like the volume for the first half of January hasn't been quite as robust as November and December has been. We'll have to see. There's a lot of conferences in early January. Sometimes the year can start off a little slow for the first 2 weeks. Possibly the higher interest rates took a little bit of steam out of the market late last year, but hopefully the second half of the month will show an uptick. And my data right now is anecdotal. It's what I see in the publications, the press releases, and so forth. We'll have to wait till the end of the month to see if it holds up to where we were in December, but feels a little bit lighter so far.
And our Did You Know for the week, Manus, is going to spotlight our year-end 2024 review that you've done on the extent of the office collateral damage.
Yes, I don't know if I'll get credit for coining the term. I'm not sure if anybody else has come up with that. I certainly didn't come up with retail apocalypse, but maybe office collateral damage can be mine. I don't know. Maybe should I copyright it? Do I get money every time they reference it on CNBC if I do? Should I make a t-shirt? I don't know. But in any event, we looked back on the last 6 months of sales that had taken place across the US where the sale price that took place during that window was below what the sales price had been for a similar property the last time that property sold. So what we did was we aggregated all this data, and it's actually more like 9 months of data, where we said, let's look at all the data. Let's see what trends we can get out of this. I think the most important thing that has come out of the study is that we're seeing hundreds of these transactions take place. It means that people are not afraid of pulling the trigger, I should say, on buying a property if the price is right. That people will come in and pick something up on the cheap if they think that the pricing is right. And that is the basis for a bottom forming and economic activity starting to pick up. So I think 2025 will be better, even for office. Transparency is there, activity is there, and that should lead to even more activity. A couple of did you knows out of this. One is that, and maybe this is just so obvious that we can't avoid it, that the average decline in property prices for things that were expensive, for properties that sold for more than 50 million and up. So probably the high end of the market, luxury properties, Class A's, those have held their value a little bit better than the B's and C's. Those properties saw an average discount across the last 9 months of about 50%, meaning for those properties that sold for 50 million or more today, the average dip from the prior sale was about 50%. When you get below that $50 million number, the discount gets much, much bigger. Things are really in the discount bin there. The average price off sale for things that sell in that range, 0 to 50 million, was 75%. So a bifurcation of the market taking place. Maybe it goes without saying, right? Quality holds value better than non-quality, B's and C's. Maybe this is as obvious as it gets.
I think about the timing. I think about the previous two downturns, call it like 1990 and 2008. It took a lot longer for the bottom to be reached because we went years without any deals happening. So the fact that just in, you said the second half of 2024 or the final 9 months of 2024, the fact that we're seeing this pretty definite bottom forming in office markets in some of the major US cities, I mean, that's very, very telling. It's good to see because it shows, as you said, that the market is kind of finding its bottom, and that can only encourage more buyers to take the plunge and jump in and grab assets when they can, if the numbers make sense.
Spot on. My last data points are these, and that is in many markets, we're seeing a lot of unanimity, a lot of clustering of prices around things. And again, this is a sign that people are seeing where the value is and agreeing what the value is. So let me talk about this. In Chicago, we're seeing clustering coalescing in the range of $50 to $75 a square foot. Yes, this is a bell curve. You get outliers above that. We saw a couple of sales at $35 a square foot. But when we look at that bell curve, the vast majority of Chicago sales are coming in $50 to $75 a square foot, right? When you're talking about a buyer and a seller, they can agree, okay, this is where the market is in the Windy City right now. When you turn to Washington, D.C., it's the same thing. That bell curve is coalescing around $125 to $175 a square foot. A far cry from where we were 5 years ago. But again, many, many sales have landed in that part of the bell curve. And lastly, in San Francisco, the going rate there is $275 to $300 a square foot. Sometimes you see $235, $240. Sometimes for a real trophy, maybe you're still getting $350 or $400. But buyers are clustering around that $275 to $300. So there's a lot of data out of here, a lot to pull out of this. We look forward to doing this again at the end of next quarter to see if these trends hold up. But some real interesting data when you scratch beneath the headlines and the surface.
So in closing, I know many of us have seen the reports and maybe personally have seen, because I'm in New Jersey, the drones that are flying in the air, where there was a detailed story in online publication talking about how retailers are going to be surging toward drone deliveries. And we could expect in the next 5 to 10 years about 100,000 or 200,000 of these flying robots
I feel like they've been talking about this for years. A couple years ago, I couldn't wait to put a little mat on my front porch and have a little drone land on it. And now I feel like the newness is kind of worn off. I wonder why it hasn't happened yet. It's dangerous to think about the air traffic problems it could cause. What does it mean for birds? The dogs will still go crazy, whether it's a drone landing or an Amazon truck backing into the driveway.
Count me as not a fan of this. I think that, I saw my kids, evolve from getting up off the couch, walking down the street, picking up a sandwich, going to get a pizza, to never leaving the recliner, waiting for the door knock, walking to the front door and picking something up. I think we're a sedentary society. I think we need more fresh air, more sunlight, just for our own physical and mental health. So let me be the first to say that I hope this drone thing never takes off. And I certainly hope that they're not delivering hot coffee this way.
Is that a pun? Take off?
Pun not intended.
Well, we'll see. Maybe it'll help retail sales really go through the roof. Thanks to our producer, Josh Bruning. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcasts@lightboxre.com. Thank you for listening and have a great week.
Let's go.